Most traders say they understand probability. They know not every trade will win. Risk management matters. Losses are part of the game, but when a trade loses, they react as if it wasn't supposed to. That reaction reveals the truth. They don't trust probability. They still believe each trade should work. In this video, we're going to explore what it really means to trust probability and why this is the foundation of consistent trading. Every trade is random. This may challenge you. Even if you have a strong edge, any individual trade is statistically random. A 60% win rate does not mean the next trade has a 60% chance. It means, over a large sample size, results converge towards 60%. But emotionally, traders don't think in sample sizes. They think in single outcomes. When you emotionally react to one loss, you are trading the outcome, not the edge. Professionals think in series, not moments. Why the brain hates probability? Your brain is wired for certainty. It wants patterns that guarantee safety. But markets operate on uncertainty and distribution. This creates internal tension. When a loss happens, your mind says, something is wrong. I need to fix this. Maybe the strategy stopped working. This is the illusion of control. Probability does not feel safe. It feels unstable. Trusting probability requires emotional maturity. Short-term pain, long-term edge. Let's say your system has 55% win rate, 1 to 2 risk to reward. You could still experience 5 losses in a row, 7 losses in a row. That doesn't invalidate the edge. It validates the distribution. If you interfere during a losing streak, reduce size emotionally, skip valid setups, change rules impulsively, you break the statistical advantage. Trusting probability means allowing short-term discomfort. Trust is built through data. Trusting probability is not blind faith. It is built through backtesting, journaling, tracking metrics, reviewing sample size. When you see 100 trades, 200 trades, 500 trades, your nervous system relaxes. Data stabilizes emotion. Most traders don't trust probability because they don't track enough data. They trade based on memory, which is emotionally biased. Probability and detachment. Detachment from outcome becomes easier when you deeply understand probability. You realize this trade is just one event in a long series. It does not define you. It does not validate you. It does not threaten you. It is simply a data point. This shifts execution from emotional to mechanical. A probability mindset practice. Before placing a trade, say internally, this is one of the next 100 trades. Not the next trade, one of the next 100. This widens your perspective instantly. After a loss, repeat, distribution. Not failure, not mistake, distribution. Over time, this reframes your internal dialogue. When trust is real, you'll know you trust probability when a loss doesn't change your posture, a win doesn't inflate your ego. You execute the next setup identically. Consistency is not emotional stability. It is probabilistic thinking embodied. The market is not a single event. It is a long distribution curve. If you trade moment to moment, you will suffer emotionally. If you trade the series, you will operate professionally. Trust the edge. Execute the series.